welcome to the deep dive.
Oh!
Okay, let's jump right in. Big news. Moody's has downgraded the U.S. credit rating, dropped it from AAA. And this wasn't just any AAA rating. This is the last one the U.S. held.
Yeah, that's the really critical part here. I mean, Moody's kept that rating solid since, what, 1919?
Wow, 1919.
Think about everything that happened since then. The Depression, recessions, wars, Nixon taking the dollar off gold.
All of that.
And they held firm. So for them to make this move now, well, it says something pretty serious about how they see the U.S. financial situation today.
It really does. So, okay, why now? What's driving this, and what could it actually mean for the U.S. economy? Things like Treasury yields, the dollar.
And importantly, how it might ripple out and affect you, the listener.
Exactly. How does it impact your finances? That's what we want to unpack. We're digging into some insights from a recent discussion over ITM trading on YouTube to sort of break it down.
Okay, so the core reasons Moody's gave basically boiled down to two things. One, the massive amount of U.S. debt.
Right.
Just mountains of it. And two, the political instability, the gridlock. And maybe most importantly, no real believable plan to fix either problem.
So it's like Moody's is putting up a flag saying, hey, the perception is changing. U.S. debt.
Yeah.
Maybe not that totally ironclad, risk-free thing anymore.
That's a good way to put it, that aura of, ultimate safety. It's definitely been knocked a bit.
It's kind of like your personal credit score, isn't it?
Exactly like that. Your score goes down, borrowing costs you more. Same for the government. A downgrade usually means they'll have to pay more interest to borrow money.
And the amount they need to borrow is just staggering. We're talking nearly $37 trillion in debt now.
Almost $37 trillion. And get this, the interest alone, just the annual interest payments, have hit $1 trillion.
$1 trillion a year, just on interest.
Just servicing the debt. It's hard to even wrap your head around that number.
It really is. And that brings us to Treasury yields, right? Explain those quickly.
Sure. So the government borrows money by selling Treasury bonds. The yield is basically the interest rate the government pays on that borrowed money. It's what lenders, the bond buyers, earn.
Okay. And you mentioned confidence before. How does that play into yields?
It's an inverse thing, usually. High confidence in the U.S. paying its debts means investors feel safe, so they accept lower interest rates, lower yields.
Because it's seen as low risk.
Right. But if confidence dips, like this downgrade suggests it might be, well, investors start seeing a bit more risk, so they demand higher yields, more interest, as compensation for taking on that perceived risk.
Lower confidence, higher yields. Got it.
And for decades, the U.S. had this huge advantage, the dollar being the world's main reserve currency.
Everyone needed dollars, so everyone bought treasuries.
Pretty much, which meant huge demand for U.S. debt, allowing the government to borrow tons of money pretty cheaply. Low interest rates, it was a sweet deal, frankly.
But now, that seems to be changing. The debt is enormous, and we're hearing about other countries looking to use the dollar less.
Exactly. It's like a double whammy. The debt's ballooning, just as global reliance on the dollar might be starting to fray around the edges. And that's where the risk of a debt spiral comes in.
A debt spiral? What's that?
It's where you reach a point that you have to borrow more money just to pay the interest on the money you've already borrowed.
Oh, wow.
Yeah, it feeds on itself. It becomes a really dangerous cycle.
Now, these credit ratings, they mainly look at the risk of outright default, right? Like the U.S. government just saying, sorry, can't pay.
Correct. That's their primary focus, default risk.
But there are other ways things can go sideways, aren't there? Even if there isn't a formal default.
Absolutely. One major concern, something ratings don't directly measure, is the possibility of, printing money.
Just creating more dollars electronically to pay the bills.
Exactly. It avoids a default in name, but it devalues the currency itself. If you flood the market with dollars, each dollar buys less. That's inflation.
And potentially serious inflation if it gets out of hand.
Right. And we've heard some pretty stark warnings. Ray Dalio, for instance, big name in finance.
Yeah, everyone knows Dalio.
He's basically said, expect things to get a whole lot worse. That's not a rating agency. That's a major investor sounding the alarm.
And wasn't there something about an official, maybe Treasury secretary, admitting these downgrades are lagging indicators, like the real problems might already be deeper?
Yeah, I saw that mentioned. It suggests the official ratings might actually be playing catch-up to the reality on the ground. The situation could be more precarious than the rating alone shows. There's even talk of a sell America sentiment growing globally.
Okay, so beyond warnings, are we seeing actual changes in behavior? You mentioned central banks earlier.
We are. Central banks worldwide are making some interesting moves. One of the biggest is buying gold. Lots of gold.
Really? How much?
Record levels, actually, modern record levels. In just the first quarter of this year, reports showed they snapped up something like 244 tons.
244 tons in 3 months.
Yep. And that was about 25% above the average quarterly buying over the last 5 years. So a significant acceleration.
Why gold, specifically?
Well, think about it. Gold doesn't have counterparty risk. Its value isn't dependent on any government's promise to pay.
Right. It's not someone else's liability.
Exactly. And you can't just print more gold when you feel like it, unlike fiat currency. So, in times of uncertainty about currencies and government debt, gold starts looking pretty attractive as a store of value. It suggests a growing worry about the whole system, maybe especially the dollar's long-term stability.
Okay, let's bring this back home. We've talked about yields, debt, global shifts. How does this Moody's downgrade and these bigger trends actually hit the average person? How does it affect you?
Okay, the most direct way is often through interest rates. Those rising treasury yields we talked about. They tend to push up other interest rates.
So things like credit cards.
Credit cards, mortgages, car loans, student loans, anything where you borrow money, it likely gets more expensive. Your monthly payments could go up.
And at the same time, you've got inflation potentially eating away at your paycheck.
Right.
Things cost more, but your wages might not keep up.
Precisely. Your cost of living increases, but your purchasing power stagnates or even drops. The money you've saved buys less and less over time.
So savings erode, borrowing gets pricier.
And any future debt you might take on costs more too. Plus, there's the bigger, maybe scarier risk if things really escalate, hyperinflation, where the currency value just collapses.
The source material also mentioned a potential confidence currency crisis. What does that look like?
It goes back to trust. The dollar works because people believe in it, believe in the U.S. economy backing it. If that confidence seriously erodes and things like the Moody's downgrade chip away at it, other countries diversifying chip away at it,
Right.
then you could see a rapid flight from the dollar. People in countries trying to dump dollars for other assets, that could cause its value to plummet very quickly. Some even talk about a kind of financial reset scenario where the dollar's value gets drastically adjusted downwards. It's a serious, though hopefully still distant, possibility.
And in that kind of chaos, historically, what happens?
Well, this is where gold often comes back into the picture. Historically, during major currency crises or periods of high inflation, gold has tended to hold its value much better than paper money.
As a way to preserve wealth when currencies fail.
Exactly. It's acted as a safe haven, a tangible asset outside the failing system. The fact that central banks are buying it up now, well, it suggests they might be thinking along those same historical lines. Hedging their bets, perhaps?
So the source we looked at called this downgrading a warning shot. Not necessarily panic time, but a clear signal.
I think that's the right way to frame it. It's not the end of the world tomorrow, but it's a serious flashing light on the dashboard. It highlights these deep underlying trends to the debt, the political issues, the shifting global landscape.
And it's significant because it's Moody's.
Right.
After holding that rating for over a century through so much turmoil.
That history gives it weight. It tells you that something fundamental might be changing in their assessment of U.S. financial strength and stability.
And it really drives home how linked everything is. Decisions elsewhere, like countries moving away from the dollar, have real consequences here for you.
Definitely. So maybe the thought to leave you with is this. Given everything we've discussed, the downgrade, the debt, the global shifts, the central bank actions, what assumptions do you hold about your own long-term financial security? Are those assumptions still valid? It might be worth thinking about how these big global changes could potentially affect your own plans and strategies down the road, something to mull over.